Welcome to lecture 11. Now in this lecture we will study financial crisis. So let's get started. Now to give you a preview, in this lecture we will first discuss what we mean by a financial crisis. Second, we will discuss what are the sequence of events that characterize a typical financial crisis. In terms of learning objectives, after this lecture, you should understand what do we mean by the term financial crisis and why is it so detrimental to economic activity. Second, you should have a good understanding of the three stages of a financial crisis. To begin with, it is important to understand what constitutes a well-functioning financial system. Now, a well-functioning financial system involves an efficient allocation of capital from savers to borrowers. And this is possible because financial intermediaries like commercial banks solve asymmetric information problems such as moral hazard and adverse selection so that capital is allocated to its most productive users. These asymmetric information problems are also referred to as financial frictions. And a well-functioning financial system works by reducing such financial frictions. Now that we know what is a well-functioning financial system, we can define what we mean by a financial crisis. Financial crises are major disruptions in financial markets that are characterized by sharp declines in asset prices and firm failures. In particular, a financial crisis occurs when information flows in financial markets experience a particularly large disruption. These disruptions cause financial frictions to increase sharply, and as a consequence, financial markets stop functioning during a financial crisis. This, in turn, causes economic activity to collapse. Now, as earth-shaking and headline-grabbing the most recent financial crisis was, it was only one of a number of financial crises that have hit industrialized countries over the years. These experiences have helped economists uncover that financial crises in advanced economies usually progress in 2 and sometimes 3 stages. The first stage of a financial crisis is credit or an asset price boom, followed with a bust. Following the bust, the second stage is usually a banking crisis. And if the fall in economic activity is severe and prolonged, this may lead to the third stage, which is called debt deflation. Debt deflation occurs when a substantial unanticipated decline in the price level sets in, which leads to a further deterioration in firms' net worth because of the increased burden of indebtedness. Now let us understand the first stage of a financial crisis, which involves a credit boom and bust cycle or an asset price boom and bust cycle. We'll discuss the credit boom and bust cycle first. Now what do we mean by a credit boom? Well, a credit boom is a rapid expansion of lending by financial institutions, which is also referred as a lending spree. Now, what are the potential causes of a credit boom? Well, one of the reasons can be financial innovation. Financial innovation is the creation of new financial instruments like mortgage-backed securities, something that we defined and discussed in lecture 5, and collateralized debt obligations, or CDO for short, and we'll discuss more about CDOs in the next lecture. The second reason for a credit boom is when emerging countries engage in financial liberalization. Financial liberalization is the elimination of restrictions on financial markets and institutions. In the long run, financial liberalization promotes financial development and encourages a well-run financial system that allocates capital efficiently. However, in the short run, financial liberalization can prompt financial institutions to go on a lending spree, leading to a credit boom. Unfortunately, if financial institutions and government regulators do not have the expertise or right incentives to screen and monitor credit risks, then financial liberalization can lead to overly risky lending. Mexico in 1994 and East Asian crisis in 1997 are some examples where financial liberalization in emerging economies resulted in a credit boom and later a financial crisis. Third, while government safety nets are important to avoid system-wide bank panic and bank run, something that we will soon learn in this lecture, such government safety nets like deposit insurance weaken market discipline and increases moral hazard incentive for banks to take on greater risk than they otherwise would. Because lender or savers know that government guaranteed insurance protects them from losses, they continue to supply funds to even undisciplined banks, knowing that their deposits are insured by the government. All in all, whatever be the reason, ultimately credit booms often lead to a spike in credit risk. Now, what is credit risk? Well, credit risk is the risk that banks and other financial institutions face in the event borrowers default on their loans, or in other words, if the borrowers fail to pay back their loan. Eventually, losses on loans begin to mount, and the value of the loans on the asset side of the balance sheet falls relative to liabilities, thereby driving down the net worth or capital of banks and other financial institutions. With less capital, these financial institutions cut back on their lending to borrower or spenders, a process called deleveraging. Furthermore, with less capital, banks and other financial institutions become riskier, causing lender or savers and other potential lenders to these institutions to pull out their funds from the banks. Fewer funds mean fewer loans to fund productive investments and a credit freeze. The lending boom turns into a lending crash. Apart from a credit boom and bust cycle, the first stage of a financial crisis can also be characterized by an asset price boom and bust cycle. So what is an asset price boom? Well, an asset price boom or an asset price bubble is when price of assets such as equity or real estate or any other asset is well above the fundamental economic value. As we have discussed earlier in this course, the fundamental economic value of any asset, whether it is a bond or a common stock, is based on its expected future income stream. When the price of an asset is well above its fundamental economic value due to investor psychology or irrational exuberance, we have an asset price bubble. The tech stock market bubble of the late 1990s in the US and the housing price bubble before the 2007-2009 financial crisis are some examples of asset price bubbles. When the bubble finally bursts and asset prices realign with fundamental economic values, stock and real estate prices tumble and companies see their net worth decline. As a result of the decline in net worth, the value of collateral these companies can pledge drops as well. Now, these companies have less at stake because they have less skin in the game. And so they are more likely to make risky investments because they have less to lose. In other words, the problem of moral hazard becomes more severe. As a result, financial institutions tighten lending standards for borrowers or spenders, and overall lending contracts. The asset price bust also causes a decline in the value of financial institutions' assets, thereby causing a decline in the institution's net worth, hence a deterioration in their balance sheet, which causes them to deleverage, steepening the decline in bank lending and economic activity. If the deterioration in bank balance sheet is very severe, This may cause the overall value of bank assets to be less than the total bank liabilities. In such a scenario, the bank's net worth becomes negative. In other words, the bank becomes insolvent. And this is not a problem if only one or two banks become insolvent. But if the problem is systemic, then a system-wide bank panic can lead to bank runs where all depositors line up at the bank to withdraw their deposits. And a bank run can cause even healthy banks to fail, because at any point in time, banks do not keep all their assets in liquid cash. Bank panics were in fact a key feature of all US financial crises, including the Great Depression years between 1930 and 1933. And it is precisely to avoid bank panics that the Federal Deposit Insurance was introduced in 1933 in the US, where the government fully insured deposits. The Federal Deposit Insurance meant that depositors didn't need to run to the bank to make withdrawals, even if they are worried about the bank's health. So while government safety nets are important to avoid bank panics, as we have discussed earlier in this lecture, such government safety nets can also increase moral hazard problems and cause banks to engage in overly risky investments because they know that deposits are insured by the government. Now, it's not necessary that every financial crisis will have this third stage of debt deflation. But if the third stage does set in, it can lead to a large decline in economic activity and prolong the recovery process. Now let us understand what is debt deflation and how it sets in. To begin with, as we understand by now, as asset prices fall, this causes firms and financial institutions' balance sheet to worsen. This causes asymmetric information problems to become more severe, and as a result, both demand and supply of loans decrease, which decreases aggregate investment. As aggregate investment falls, this leads to a severe fall in economic activity where output Y is significantly below equilibrium output Y bar. And as we know from our lectures on optimal monetary policy, where we discussed the Phillips curve, when output is below aggregate output, this leads to a drop in general price level or deflation. Debt deflation occurs when a substantial unanticipated decline in the price level sets in, leading to a further deterioration in firms' net worth because of the increased burden of indebtedness. Now, if you recall from the previous lecture on the transmission mechanism of monetary policy, an unanticipated increase in the price level improved the firm's real net worth by decreasing the burden of debt in real terms, right? Exactly with the same reasoning in reverse, an unanticipated decrease in prices increases the firm's debt burden in real terms because debt repayments are fixed in nominal terms. But as the value of assets do not change in real terms, the real net worth of businesses and households go down. This decline in businesses and households' net worth further worsens asymmetric information problems, which further decrease lending, which further contracts economic activity even further, and finally, this leads to even lower prices. And this cycle or deflationary spiral can continue to lead an economy into a recession or even a depression. So that ends the discussion on characterizing a general financial crisis. In the next lecture, we will do a case study on the most recent global financial crisis. So that's it for now. Thank you.